Hello and welcome, What the Finances, to another episode of the What the Finance Podcast, where we talk to experts to help gain a greater understanding about what is happening in the world of finance, investing, and markets. So, on today's podcast, I'm happy to welcome Alasdair Macleod, who's head of research at Goldmoney, educator for sound money, and trying to help demystify finance and economics, which is pretty hard at the moment. So, Alasdair, thanks for joining the podcast today.
That's my pleasure.
So my first question, I've listened to quite a few of your interviews recently, and you've talked a lot about the importance of bank credit in economic growth. So I guess, why is this so important? And in your opinion, do you think we're getting to, the late stage of a debt crisis and probably or a debt cycle to the point where we might see a crisis?
Well, the reason it's important is that pretty much every transaction that in gross domestic product is settled in bank credit. I mean, at the retail end, there's a little bit, and even less nowadays, actually settled in central bank credit, which is banknotes and loose change. But really, for all intents and purposes, GDP is totally settled in bank credit. So obviously, if you expand the quantity of bank credit, GDP goes up. It's got nothing to do with whether people are, sort of producing more or whatever. It's just the quantity of credit, which is actually what you're reading. And equally, if you get a contraction of GDP, it is because the banks are reducing the quantity of bank credit. Again, it's got nothing to do with you or I suddenly deciding that, we're going to draw in our horns, we're going to save rather than spend, or, that's for the fairies. It really is. It is all to do with bank credit. And that is the important point which everybody should really understand. Don't listen to the economists who routinely tell you that, the economy is expanding. Oh dear, we've got we're in for a recession or whatever. It's all about bank credit. So that's the answer to your first question. Second question is that we do have a cycle of bank credit. And bankers are human. If you start from a point where, let us say, we have had a slump in business activity, which is generally, again, because there has been a slump in the expansion of bank credit, it has gone into contraction, you will find that gradually things settle down and bankers are still reluctant to lend. But do you know what? They've got their favorite entrepreneurs. They've got businesses which they've had long-standing relationships with, businessmen they trust. And these guys sort of start thinking, I'm going to start picking up some cheap businesses, so they go on the takeover trail. I mean, for example. And so they go along to the banks and say, I've spotted this opportunity. I think it's going to go really well. Here's my business plan, da-da-da-da-da. And the banker will rely on the proven ability of these company doctors, if we can call them that, to buy businesses. So they start extending credit. And it's very cautious to begin with. But of course, as you extend credit, what happens? GDP starts growing again. What does the banker think? The banker thinks, it looks like the recession is over. It looks like things are on the up. So perhaps we can be a little more positive about, if you like, examining propositions for loans. And so you gradually get this developing, and then it gets to the point where banks started competing with each other for loan business. And they start talking about, we need to get these customers or this customer in for strategic reasons. He's very, very important. So we will offer him a credit deal which he can't refuse. So you get this. So what you do with the expansion of credit, you find the cost of credit goes down. Now I'm talking of course about free markets because central banks muck everything up. So let's put that to one side for the moment. Then what happens is that the expansion of credit going into the general economy obviously creates excess demand because people don't understand what's going on. They see that things are improved. They see that there's demand for this, demand for that. Companies start hiring again and all the rest of it. And so you find that, businessmen who, a little earlier in the cycle, manage to persuade a bank to lend them money for a project, they find that the arithmetic in the project starts going wrong. And the bankers are aware of this. Inflation's picked up, there's labor shortages, there are supply bottlenecks and all the rest of it, all as a result of the earlier credit expansion. Now, the banker doesn't actually realize this because he's not an economist, he's just a commercial banker. But what he then finds is that enough of these businesses who he has lent money to, and who also his competitors have lent money to, start finding that things aren't quite working out as they should because of the bottlenecks, because of the lack of available staff, because of the supply difficulty, whatever. And commodity prices have risen, all these factors. So what does he do? He starts being a bit cautious. And of course, at this time, his balance sheet has expanded from, say, total assets being somewhere between, say, 8 and 10 times, or 7 or 8 times, something like that, his, the shareholders' equity, to, guess what, something like 13 or 14 times. Now, this works the other way. I mean, it's lovely when things are going well. I mean, you've got, let's say, a profit margin between, in your credit deals between loans and deposits, say, of an average of 2%. You gear that up 10 times. I mean, that's a 20% return for the shareholders, or a gross return for them anyway. But once things start going south, that starts working against the banker. Now, what he will do is he will run scared. He will go from greed to fear. And they then take out all the offers in the market. You find that overdraft facilities are cut, everything. And you'll also find that when overdraft facilities are coming up for renewal, banker says, sorry, we're not renewing your overdraft facility. So they're trying to contract their balance sheets. And where we are in this cycle of bank credit is, if you look at the balance sheets in Japan, they're more than 20 times leveraged between total assets and shareholders' equity. In the European Union, they're more than 20 times. I mean, these are record levels. And the reason they got there was by reducing interest rates to negative figures. It just compressed the lending margins so tightly that in order to maintain profitability, the banks just had to lever up their balance sheets in order to do that. And now, of course, they've got themselves abandoned in a situation where interest rates are rising, and it's a rise that's only just started. I'm not saying it's going to immediately go to 10% or whatever, but this process of rising interest rates is early in the game, and the bankers can see this. Now, what the hell do? They know that they're about to collapse the whole thing. But I tell you what, last one to reduce his balance sheet is a sissy, and that is the problem which we now face.
Yeah, it's interesting. So is that why maybe we're seeing a lag? It gets to the point where once, I guess, if you look at housing in the UK or Australia, it's variable. So once variable changes occur, that's when we might see defaults, as you said there. It could be sort of overdraft contracts. It could be a year or whatever. And then once that comes up to renewal, that's when we're going to really see this impact. Is that sort of what you're seeing?
Well, it's happening already. That, of course, what I've described, if you like, is the classical relationship between bank credit and the economy. Today, however, and particularly since the ending of the Bretton Woods agreement, or rather its suspension, because believe it or not, it was suspended, not ended, the expansion of bank credit has been very much into financial activities as opposed to non-financial activities. I mean, basically, manufacturing has just gone off abroad anyway. So the idea that a banker makes credit available as part of the establishment of a factory to produce goods in 5 years' time, whatever. I mean, a lot of that's gone. It's all gone to China or Southeast Asia or wherever. But so what they've done is, of course, they finance speculation. And from Big Bang in London onwards, I mean, this has been the trend. The whole of the derivatives market built up on the back of this trend. It didn't exist before 1980. Now you've got over 600 trillion of notional over-the-counter derivatives, and you've got a further 50 trillion of regulated futures derivatives around the world. And these are the preserve of the large multinational banks. They're the people who create this. It's a very different thing. So what they're doing is they're contracting that side of it. And if you look at, for example, the margin accounts in America, and these are figures which are produced by NASDAQ. You can see that the amount of margin credit has just completely, it's nosediving, and that's why the stock market is itself diving. I mean, the buyers can't get finance, so you can see that it has already started. And if you look at other statistics, and I hate statistics actually, because you've got to understand the story rather than just look at numbers, because numbers are, well, I think it was a prime minister, an earlier prime minister, Lord Canning. I'm going back to 1827, 1824, round about then. He said, I can prove anything with statistics except the truth. And that's something we ought to remember. Anyway, I mean, now we rely totally on statistics, government statistics. So, of course, they're right, because the government would never tell porky pies. Anyway, we'll just pass over that one a little bit. But you can see that if you look at broad money supply, which is basically bank credit, or it's something like 9/10 of it is bank credit, even more, then you can see that it stopped growing. If you look at loan officer surveys in America, bank loan officer surveys, they're now, saying no. I mean, the amount of loans that they turn down now exceed the numbers that they grant. I mean, I'm talking about, serious propositions, and, all this can be charted and so on and so forth. But I think rather than paying too much attention to these numbers, you can see the direction in which it's going. And we were warned, actually, of this way back in April, because the most senior commercial banker in the world, one Jamie Dimon, stood up at a banking conference in New York and said, 2 weeks ago, I described the global economy as being in a storm. I'm upgrading that to hurricane force. Now, what he was saying was that as a commercial banker, I don't like lending into this environment. I'm going to start controlling my risks. Now, that was the clearest signal to anyone who was asleep at the banking switch as to what is actually happening and what they should do and how they should respond. But they all respond at the same time. So you find that the collapse tends to be quite sudden. And the other thing fueling it, of course, is rising interest rates. And as interest rates rise, this means that businesses which finance themselves on the basis that interest rates were lower have a problem. And the bankers pick up on this. So they can see that their non-performing loans are going to increase very, very substantially. They don't want that, obviously. And particularly when you're highly leveraged, I mean, it's not going to take very much in the way of bad debts to wipe out your equity. And we've seen this with Credit Suisse. I mean, there's a prime example. And Credit Suisse was by no means the most highly leveraged of the major global systemically important banks, the GSIBs. I mean, it's for some time the share price has signaled that Credit Suisse, is not that attractive an investment, because they're standing, and I think it's still standing at something like a 75% discount to book value. That's, that is option money on Credit Suisse's survival. It's not just Credit Suisse, also banks like Deutsche Bank are in exactly the same position. So we have the potential for a mega commercial banking crisis. And you know what? Normally the function of a central bank is to ensure that you don't get bank failures. But if you look at the balance sheets of the central banks, you got the same story there. Why? Because they've been indulging in QE. They have been buying bonds, which with rising interest rates, the yields have been rising, and the mark-to-market values have been collapsing. The Swiss National Bank apparently has lost, in the first 9 months of this year, has lost something like 20% of Switzerland's GDP on its investment portfolio. I read an article in the Telegraph written by Andrew Evans Pritchard, and he said that the losses at the Fed are in the order of $1 trillion. I didn't actually quite get that. I didn't get it that bad. I thought, we were looking more like sort of somewhere in excess of 500 billion. But anyway, I'll go with what he says. You have the Dutch National Bank turning around and in a letter, I can't remember, I think it was to a politician or something like that, who's saying that effectively, we can cover our losses on the bond portfolio, in other words, acquired through QE, by revaluing our gold reserves. So you can see that, this is beginning to become a story, that the people who are backstopping the commercial banking system are themselves in need of recapitalization. So how's this one going to play out? It's an interesting conundrum.
Yeah, it's fascinating. And, you mentioned there that we could see a bit of a liquidity crisis very quickly. And I think a good example of that is the UK and what we saw recently with a lot of, they weren't banks, but pension funds were highly leveraged to try and get that returns. And then that basically a lot of them almost became sort of insolvent because of that. So do you see that happening in, I guess, other markets and bigger markets around the world?
Yeah, I mean, basically, when you get, a sort of a 600 trillion OTC derivative pile going into contraction, you're going to have problems. I mean, it's as simple as that. Counterparty risk is going off the charts. I mean, it really is. We've seen, Credit Suisse is very much counterparty risk for all the other banks, and that has not helped them. I mean, they're trying to recapitalize themselves. And part of what they're doing, I think, rather sensibly, is they're trying to flog off their credit origination, their OTC derivatives origination business. But I would sort of think, would I really want to buy that in this environment? I don't think so. Yeah, I mean, if you're going to get a contraction of something as major as that, then there are going to be problems. There are going to be accidents. To rely on the central banks to ensure that we don't have a problem with rising interest rates and the impact on commercial banks and all the rest of it is actually a very, very big ask, and is particularly it's made worse because I'm not convinced that every central bank actually knows what it's doing, and I'm pretty sure also that they've got to play to the political audience probably more than common sense would dictate. So, remember that after the Lehman episode, the G20 got together and, they did two things, really. They said, the first thing they did was they said to the Bank of International Settlements, can you revise the Basel Agreement to deal with liquidity? Now, the liquidity issue is not the same as the capitalization issue. Broadly, what Basel III says is that you can leverage up your balance sheet if you want, to the extent that tier one capital, in other words, equity, need only be 3% of total assets. Now, this is 33 times bank leverage. Come on, this is ridiculous. There are sort of things that go in on top of that. So it's probably not quite that naked, but you can see that the regulators are not aware, hardly aware, of what should be driving the commercial decisions of senior bankers. I mean, they have got to look to their shareholders. They've got to protect their shareholders. To hell with a regulator, they've got to protect their shareholders. That's the important thing. So Basel III misses the point entirely on that one. And the second thing, of course, is that due to our wonderful Gordon Brown, who was he was Prime Minister, I think, at the time, who sort of was jumping up and down at G20 meetings, trying to rescue the world. He persuaded everybody that we've got to do bail-ins and not bail-outs. Oh, come on. He didn't actually understand what he was talking about. The idea that the taxpayer is on the hook in a bailout is not true. Because what do? They just print the credit to bail out banks. It's not the taxpayer on it. It's all of us through the debasement of our currency. What does a bail-in do? Basically, what it does is it means the bondholders in a bank just run scared at the first sign of any problems. So all I can say is that any jurisdiction, and we're talking about the 20 top G20 jurisdictions who have all complied with this command to legislate for bail-ins. Anyone that tries that will just collapse the banking system far more quickly. So I'm saying that there are dangers out there which are unique to this event, and we've got to be very, very alive to it.
Yeah, well, that's fascinating because, as you said, Credit Suisse probably has quite a lot of counterparty risk because most governments, they might only insure for a few $100,000. So then a lot of people would go into government bonds for the rest of their earnings, especially wealthy individuals. So then if there's a threat of bail-ins, as you said, they're not going to go to those government bonds. They could go to other assets potentially. Is that where you see gold maybe becoming the safe haven in the future? Or
well, yeah. I mean, it's actually a lot simpler than that. You have to understand that there is a difference between money and credit. And as J.P. Morgan said in testimony to Congress, I think it was 1912, he said, gold is money and the rest is credit. Now, he wasn't actually just expressing his opinion as a gold bug. He was actually stating the legal position. Ever since Roman times, that has been the legal position. And they arrived at this legal position after much deliberation, over about a millennium, from the time of the 12 tables, which is 450 BC, to the time of Justinian's Pandex, which put together all the jurors' findings, because you had this system of jurors, eminent people who, sort of philosophized, thought, whatever, and stated legal principles. And there's something like 1,000, no, I think it was 9,000 of these opinions in the digest volume of the Pandex. Now, they did, I mean, basically, if you go way back to, around about the sort of shortly after the sort of the start of the Christian millennium, I think around about 200 AD, there was a juror called Alpian who laid down quite clearly what the difference was between a deposit and what they called a regular deposit, in other words, a custody deposit, and an irregular deposit, which is something that you give to a banker and it becomes his property until he cedes it back to you, and he cedes it back to you on your demand. So, but it becomes his property. So that is the basis of modern banking still today, and the law has not changed. So, I mean, we're talking about the legal distinction between money and credit. And credit really has come in two forms. I mean, there are banknotes and there is bank deposit accounts. And those retain their value so long as they are attached to money. In other words, if you can exchange your banknotes for gold coin, then there will not be a major difference between the value of a credit at a bank and a gold coin. So, and this was the basis, if you like, of the gold coin standard we had from just after the Napoleonic War up to the First World War. It was just a short century. So what we're looking at, I think, is a collapse, if you like, of the credit system, which basically means that we're seeing a collapse of the currency system. But legal money is still there. So if you're looking at it in investment terms, that's probably the wrong way to look at it. Because what is money? Money is neutral. Money is not an investment. You acquire money so that you spend it. You don't acquire money to trade it. Why? Because money doesn't have a price. And the error in the financial system today is to assume that gold is not money and therefore it has a price. What doesn't have a price, the assumption is the dollar or sterling or whatever, except against each other. So this is, they've got it upside down. It is money that has no price, not credit. Credit always has a price, even when it's attached to money. There will be a discount between gold coin and the credit equivalent. Why? Because you've got counterparty risk. So what we're looking at, I think, is not a question of investment. We're looking at a question of divestment and getting out of fiat, out of collapsing credit, out of credit risk, into genuine money, which has been genuine money formalized legally by the Romans in the Pandects of Justinian, which was 533, I think it was, AD. But that was the result of a millennium of jurors' deliberations from the 12 tables in 450 BC. That's what we're talking about. And the idea that that's no longer true is incorrect. That is the legal position. Governments have tried to persuade us that gold is a pet rock or whatever, or it's no longer part of the financial system. Yet they fail to explain why it is that central banks guard their gold reserves so jealously. I mean, the answer is quite simple. It is money, and all the rest is credit.
Unless you're Gordon Brown, who sells quite a lot of it 20 years ago.
I don't normally criticize individuals, but it's an interesting one because he was a history teacher, basically. And he didn't know anything about economics. So he went on a crash course, and he was taught economics by Ed Balls, who in those days was chief economics correspondent or whatever at the Financial Times. And, a Keynesian, rabid Keynesian, as so often they are. I mean, look, he had all the qualifications, I don't know, Oxford or Cambridge and Harvard or whatever, he did all that sort of stuff, which basically meant that he was absolutely high priest of Keynesianism, which has got nothing to do with economics. I mean, as Hayek said of Keynes, with whom he was extremely friendly. I mean, they really did help each other. Keynes was very, very kind to Hayek when he came over from Austria, almost as a refugee. He helped him get a position in the London School of Economics and all the rest of it. I mean, that I thought was extremely civilized of him. But as Hayek said, he said, Keynes wasn't an economist, he's a mathematician. And the two things are completely incompatible. But today we think that you can mathematically resolve economic problems. No, you can't. It's not the way it works. So there we are. Anyway.
Yeah, that's really interesting. So if we maybe take a step back, once we were talking about, I guess, a system collapsing, and then from there we went to this potential, actual money, which has been gold for millennium. So do you see us going to sort of a Bretton Wood 2.0? Is that what you think?
Well, not easily, I think is the short answer, because there is so much intellectual investment in fiat currencies. There is also the geopolitical situation, because China and Russia have, accumulated gold. They have based their economies to a large extent on gold, though they have yet to declare that. What this means is that if Russia, and they've, as I understand it, they have actually passed the enabling legislation to do this. So this is an interesting one. If Russia moves the gold that it holds in other state accounts into the reserve bank and declares its total gold holdings as reserves, it will then have 12,000 tons of gold reserves, which is way in excess of what the Americans have. And it is widely suspected that the Americans' 8,133 tons isn't actually there, or if it is there, it is not entire. So That's the first thing. The other thing is, if you look at the Chinese situation, I have assessed in the past, and I'm very confident of this assessment, that the state itself has accumulated over 30,000 tons by now. And furthermore, once it had accumulated the bulk of what the state wanted, in 2002, it then authorized its population to start accumulating gold as well. It set up the Shanghai Gold Exchange that year. And since then, the general public, the wider public, has had delivered, this is called withdrawals from the vaulting system, the Shanghai Gold Exchange's vaulting system, has had delivered to it over 20,000 tons. So 50,000 tons of gold currently is in China. So where does that leave us? I mean, in Britain, our wonderful fellow, Chancellor, one of the first things Gordon Brown did was he flogged most of our gold at under $300 an ounce. It's got to be one of the worst deals ever. Anyway, anyway, I won't delay. But Canada, for God's sake, that's got rid of all their gold as well. The Swiss National Bank has got rid of quite a lot of it. I don't know what they've got now, but I mean that's a tragedy, because the Swiss people didn't feel that they needed to accumulate gold because their central bank accumulated gold and it was the main plank of its reserves. But they now find themselves in a situation where the bank has gone all Keynesian on them. Got rid of quite a lot of the reserves, started investing in equities and bonds, foreign equities, foreign bonds, to try, the idea basically was to buy foreign currencies. So sell Swissy, buy foreign currencies. That way you get the Swiss franc rate down. This is pure Keynesianism. And, what do you do with the proceeds once you've got dollars and euros and things like, well, you go and buy bonds and equities. And that's what they did. And they've now lost 20% equivalent of their GDP. I mean, for goodness sake, the Swiss are in a hell of a mess on this. And I think that's very, very sad. It's very sad for the Swiss people who have not protected themselves as you would have thought they would. So that, this is not good news. It really is not good news.
So if we don't see Bretton Wood 2.0, what other systems do you think, or is it quite hard to predict, especially in the West, I guess?
Well, what's happening is that the Asian nations are trying to get out of the dollar, basically. I don't think there's anything controversial in that statement whatsoever. All the evidence is there. And what they're seeking to do instead, and these are plans still very much in formation, is to have their currencies more based on commodities rather than pure fiat. So quite how they will work it out, I don't know. I mean, I could solve this one for them in an afternoon. It really is not difficult. But, the heart of this, which is the Eurasian Economic Union, which has Russia, China, Belarusia, and those stans in the middle of Asia, north of Tibet, if you like. They are talking about a new trade settlement currency to operate between them. And they're talking about it being a mixture of their own currencies and the commodities in which they deal. So there would be presumably some sort of fixing, on this. Now, actually, the answer is very, very simple. And I've shown this statistically, dreaded statistics again, that the answer is very, very simple. Basically, just have a gold fix. I mean, just do a gold fix twice a day if you want. And interestingly, I think that could be the way it's going, because Moscow has announced that it is setting up a new gold exchange to replace the LBMA, which of course has banned the refiners and the mines. So, and Russia's the second largest producer of gold now, only next to China. So, I think they might be going that way. I mean, I think the point behind this is that these Asian nations have been moving away from the pure paper of the West because they anticipate that it would run into problems, and they needed to protect themselves from it. What we have now, I think, is a situation where they're beginning to panic. They can, I mean, if I can see it, they can see it. These guys are not silly. I mean, they're quite smart, probably a lot smarter than us. They can see what's happening. And so what they're doing, I think, is they're moving quite rapidly to try and protect themselves from what inevitably is going to be a financial disaster, in large measure, created by ourselves. I mean, particularly with the war against Ukraine. I mean, sanctions against Russia. What? The largest exporter of energy and raw materials on this earth, and we cut ourselves off from it. I mean, that's got to be the most stupid thing you can possibly imagine. Politically, I can understand it, but no, on any other basis, it's complete nonsense. And that's where we are. We've created this problem for ourselves. But if you're Russian or Chinese, you sit there and you say, look, come on, these turkeys are just screwing this up big time. Do we really want to have, okay, as far as the Russians are concerned, the dollars and the euros in their reserves no longer count for anything. But, they can get rid of it via China. But the only reserve that matters is gold now. No counterparty risk. And I think that that's the way in which it's going. So if you're looking for a return to a gold standard of sorts, I think that's where it'll happen. It's what we're getting is, I think, currencies are moving away from being pure fiat into being, let's say, and financialized. This sort of, if you like, from the 1980s onwards, this gradual trend of declining interest rates has been the financialization of our currencies. That has now ended, and we're now getting into a commodity-like environment for the world's currencies. And that is very, very bad news for Western currencies.
Yeah, it's interesting. So I guess if we go back to the start of our conversation, you mentioned how the majority of GDP growth is linked to debt. So I guess if we're quite reliant on these precious metals, where does the growth come from? Or do you think we see a bit of a stagflation? Because I guess it's not as elastic as fiat currencies.
Well, you see, this is the thing. Growth is the wrong word. And the idea of growth is a statistical thing. GDP, nominal GDP increases from point X to point X plus X, Y%. That is not economic. It's not economic progress. You cannot measure economic progress. So this growth thing, just forget it. I mean, it's a complete nonsense. All you're recording is changes in the level of bank credit and currency. I mean, what's going to happen with this is quite simple. The contraction of bank credit is going to accelerate, and that's going to accelerate very, very quickly. So what the central banks will do, being Keynesian, is they will run scared of a recession, of deflation, as they call it. And in any event, government finances will just come unstuck on this, because you will find that tax income drops, welfare commitments rise, and therefore budget deficits rocket. So what do? Do they cut spending? No, they don't. What happens is they finance the deficit, basically, out of printing money. Printing currency, rather, I should say. And this time, what we're doing is we're replacing bank credit with central bank credit, commercial bank credit with central bank credit. The impact of this is going to be far worse in terms of undermining the purchasing power of currencies than any changes in the level of bank credit. I'll give you an example from history. If you go back to France in 1720, there was an itinerant Scotsman called John Law who had exactly the same theories as John Maynard Keynes. I mean, exactly the same. And what he did was he managed to persuade the Duke of Orleans, who was the Prince Regent, because the Prince at that time was, Louis the 14th, 15th, whatever. I mean, he was a child. To rescue France, the royal family's finances, because they were hugely in debt at that stage. And he did this basically by setting up a bank, which initially was a private bank of his, which bought in government debt, and very, very cleverly managed to manage the currency situation. He then combined this with the financing of what he had bought from the Duke of Orleans, or through his kind offices, the Mississippi, the rights to the imports from North America, and also eventually all the foreign trade of France was combined in this Mississippi venture. But he needed to build ships to transport the goods, and so he needed money. So he ramped up the price, and he did this very, very cleverly. I mean, as a stockbroker, I would take my hat off to him. It's the way it's done. But the problem was that he managed to combine the puffery of his Mississippi venture with his appointment as comptroller of the currency. So he was issuing his own paper currency to buy and support the shares in the market. Now, he did a lot of this on a partly paid basis. So what was happening was that when calls were due, people were beginning to sell their shares. So he had to print money in order to buy the shares. Now, the guy who actually worked this out and how to really profit from it was a guy called Richard Cantillon, who became famous, if you like, as someone who described what became known as the Cantillon effect, and that was how an increase in the availability of money changed prices and how it filtered through. So anyway, Richard Cantillon, he made several fortunes out of this, but the last fortune he made out of it was quite simple. He decided not to short the stock. The thing to do was to short the currency. And so he went to London and Amsterdam, which are the two main foreign exchanges at the time, and sold short French livres in huge quantities. Now, the outcome of this was in 1720, the peak of the shares was around about 13,000 livres in February 1720. By September, the shares had fallen to around about 3,000 or 4,000 livres. And indeed, the company continued after that. I mean, we had to kick the French out of India. Basically, that was Clive of India, about 30 years after that. So the company survived that. But what happened to the currency? There was no quotation in London or Amsterdam for the currency because it was completely valueless. So Cantillon got it right. It was the maneuvers of trying to protect the financial assets in France that did for the currency. And what are we doing now? The central banks are doing exactly the same thing as John Law did in France in 1720. They're trying to protect financial assets. They're trying to suppress yields. They are doing QE in order to buy in these financial assets. They will do anything they possibly can to finance the ballooning government deficits by buying in assets. So what are they going to do to the currencies? Well, John Law showed the way. He was the proto-Keynesian of his day, almost precisely. It's the only way to describe it. And he destroyed his currency. And we're doing exactly the same, not just on the scale of the French, but a global scale. Yeah, so this is why I would say you get out of credit. Credit's going to tank. And the valuation of credit is tied to the purchasing power of fiat currencies. Goodbye.
Yeah, and I guess you could say that sort of led to the French Revolution. So there's lots at stake potentially.
Well, the French Revolution was later.
Yeah.
I mean, that's an interesting one because at the time of the French Revolution, they introduced a new currency, the assignat. And of course, memories of 1720, I mean, we're talking about 1789-ish. memories of 1720 were still fresh, if you like, in sort of the government's mind and Parliament. I mean, members of the French Parliament at the time, revolutionary Parliament, were very wary of going down this paper currency route. But when the assignat was proposed, what happened was that they agreed, right, look, very, very strict limit. It's going to fill a gap. Okay, we understand that. What we'll do with these assignats, we'll do one issue, and that's it, no more. Of course, that was followed by another issue because there was another problem, another issue because there was another problem. And the assignats started collapsing. The answer then was to introduce a new instrument called the mandat territoriaux. And the mandat territoriaux lasted no more than about 6 months. It had exactly the same effect. I mean, but the fascinating thing was that, as soon as someone came up with this wonderful idea, this new all singing, all dancing paper currency, which was going to rescue the revolution, rescue the economy and all the rest of it, everybody started burning their worthless, assignat coupons, and but the replacement didn't last long. So the idea that you can replace one fiat currency with another, no, doesn't work.
Yeah, that was a great history lesson in learning about the issues of the past, and they happen again. So if we look at what happened, I guess you could say 1930s in the US, precious metals were confiscated. You couldn't privately own it. And I think that happened in lots of other countries. If this were to happen, what you suggest could happen, do you see something like that occurring where they sort of confiscate all the precious metals?
Well, yeah, I mean, it would be the most stupid thing to do. But then we are talking about something which is entering the realms of stupidity. So I wouldn't rule that out. I mean, the first person to do the really stupid thing when it came to prices was Diocletian back in 230 odd, was it 300? And I think it was about 233, something like that, AD. He produced this edict written in stone, maximum prices in denarii for everything. He had to do this because the denarii was collapsing, and this was his solution. Now, if you were, a butcher selling meat in the middle of Rome, you had this maximum price. It meant that if you were selling meat, you'd be in on a dead loss. So what do? You don't sell meat, you don't sell anything, you just shut shop, which is what happened. So everybody, I mean, if he had sold product at above the edict prices, then he would have been, he would have been, had his hands cut off, he would have, whatever, he would have been crucified, a painful death. So what do? I mean, the answer is you basically shut up shop, and that's what happened. And so Rome emptied. People just went out into the country and foraged because they had to. There's no alternative. And politicians have been doing that every time they have collapsed their currencies, put in price controls. I mean, I remember the 70s. We put in price controls. Did it do anything? No. We're doing it again. We're doing this with energy, for goodness sake. We're doing it slightly differently. We're subsidizing it this time, So the Americans, in defiance of the law, of Roman law, banned people from owning gold in 1933. And that was just before, in January 1934, they devalued the dollar by 40%. Now, that was the most dishonest thing that any government could possibly do. But I don't rule it out happening again. All I can say is that if you do acquire gold, which is a sensible thing to do, then the answer basically is to store it. I mean, if we're talking about quantity other than, say, gold coins, which you might have in your possession, store it in a foreign, in a vault somewhere else, like, Singapore or wherever, or Switzerland or whatever. Because while I wouldn't recommend that you break, this sort of law, I think it makes sense to make it just that bit more difficult for these guys to get hold of your money. Because that's what it is. It is the theft of your property that we're talking about. And this is very definitely your property, as opposed to credit, which is transferable property, which they would rather you had. So, but again, I mean, against this, I mean, the reason it would be doubly stupid today, I think, is that if they did that, you've got to think what would happen to the gold price. Or should I say, it's not the gold price, because gold doesn't have a price, but the purchasing power of the currencies, the price of their currencies, I think would collapse, because it would be the biggest expression you can imagine of non-confidence in their own currencies. And what do those currencies rely on? The full faith and credit of the government.
Yeah, that's a great way to leave it. So, Alasdair, thank you so much for your time. And I guess, is that the message that you want to leave people with, or is there another message you want people to take away from our conversation?
Well, I think that's probably enough of a message. I would say, look, take some effort to understand what is going on with, and what's the difference between money and credit. Understand that. Protect yourself from what's happening. If you don't think it's happening, then okay, that's your affair. I'm not giving advice at all. But let's just make that absolutely clear. I'm not talking about investment. If anything, I'm talking about disinvestment, getting out of the fiat currency system. If you believe me, then, and I'd actually say that belief is not enough. What you've got to do is you've got to work it out for yourself. If you come to the same conclusion as I have just put forward, then you've got to think not just about yourself, you've got to think about the society around you, your family. You have got to think about something which is going to be so catastrophic for everybody. Everybody who hasn't protected themselves, everybody who is totally committed to the fiat currency system, that it's something that you've got to really think through. And we don't know how much time we've got, but one point that I hope I have made clear is that when banks start contracting credit, that contraction tends to happen pretty rapidly. So, and with that big derivative elephant in the room, 600 trillion, which is kind of notional value, admittedly. Not all of it actually matters in the sense of notional value. But anyway, that's another story. So, yeah, I mean, the situation is actually, I think, very, very dangerous. I mean, it really is.
All right. Yeah, that's a very important message. So, Alasdair, thanks again. So if anyone wanted to hear more about the work and what you do, where would the best places for that be?
Well, I write an article for Goldmoney, goldmoney.com, hit the research tab, and they publish an article every Thursday. So we're Tuesday today. So the one which is coming out this Thursday, which is in 2 days' time, is actually what we've been talking about, and that is the legal position of money and the legal position of credit. So if you really want to gen up on that, I thoroughly recommend that you visit our website, Goldmoney website, and have a look at that. Also, I got a Twitter handle, which is @MacleodFinance, capital M, capital F. I put things on there which I hope are relevant, if you like, to the understanding, because as far as I'm concerned, my interest in this is educating people. I'm not promoting anything. And I would also say that my colleagues at Goldmoney, they take the view that sound money is really what we want to see. And the fact that it happens to be gold is why Goldmoney exists, if you like. It provides a facility for people to hold gold and silver. I mean, it's worth making the point that one way to escape the possibility of your government stealing your gold or forcing you to submit your gold is you could go for some silver, because the three forms of metallic money, gold, silver, and copper. I would discount copper, but silver, well, let's put it this way. At the time of Diocletian, the gold-silver ratio was 12. Clearly laid out in his tablets and stone. So that was 12. By the time that Sir Isaac Newton took it, I mean, he didn't actually fix it. What he did was he looked at the market rate and took that rate. It was 14 and a half, 15 and a half times. Today, we're looking at over 80 times. So if silver moves back towards some sort of monetization, then you will see that ratio fall very, very substantially. So silver actually does make some sense, either in the form of coins or alternatively in the form of bullion bars.
Yeah, thank you so much. And this is actually going up on Friday as well. So I'll put the link to that vlog post in the description below so people can read it. But Alasdair, thanks so much for your time.
Yeah, no, that would be great. Well, it's very much my pleasure.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.